All right, guys, bang, bang. Let's go. I'm going to wait a couple minutes to get some people in here, but I want to spend time today talking about the current economic recession that we are in, why it is likely to get worse before it gets better, and then what the impact on various companies are, and also how that may change things that you are thinking about doing. Before I forget, for those that are watching this after the live, please like the video, leave a comment, and subscribe to the channel. All right, we're starting to get some people in here. Hello, hello, hello. So essentially, let's just start with where are we, right? If we go back to kind of pre-pandemic, we were sitting at one of the strongest economies in history. We had seen record growth in company values. We had seen record profits. We had seen incredible rise over the last decade plus coming out of the 2008-2009 financial crisis. And then on top of all of that, we had record low unemployment. We were sitting at about 3.5% unemployment in February. And everything looked like it was going to go up and to the right forever. We were going to end up having, trillions and trillions of dollars of GDP, and everything was going to be awesome. And then the pandemic hit. And when the pandemic hit, there was two key factors that occurred. The first was it killed people. And of course, because of the health crisis, there had to be a reaction. That reaction was to essentially shut down economies. And what we did was we sent everyone home. So people will debate the merits of should we have done that, should we not? I frankly don't care. It happened. And when you grind an economy to a halt like that, what you end up seeing is that businesses can't operate. Government mandated shutdowns, right? There's unemployment that skyrockets. And so the impact of this decision to send everyone home, this government mandated shutdown, was that we saw over 40 million Americans lose their jobs in about a 12 to 16 week span. So 3 to 4 months, we saw 40 million Americans lose their job. To go back as a refresher, in 1929, which is the start of the Great Depression, there was 3.1% unemployment, record low. And that unemployment jumped from 3.1 to over 8.5% to then over 15% in the next 2 years. And so what you end up seeing is we have accelerated faster on the unemployment track than even in the Great Depression, right? It only took us a couple of months. It took 2 years to get to 15+%. We pretty much got there in about a matter of 4 months during this recession. And so as soon as you saw businesses being shut down in terms of being told to go home, 40 plus million Americans, right? There was that one big week back in March where 6 million people filed for unemployment claims. The highest ever before that was about 700, 800,000 back in 1982. So all of a sudden we saw this record-breaking unemployment number 2 weeks in a row. Remember, there were 6.6 million unemployed, 6.6 million unemployed in back-to-back weeks. The government, the Federal Reserve said we have to step in. And so when they stepped in, what they did was they created a historic stimulus package. They created a monetary stimulus package that ended up topping over $2 trillion, right? One of the packages was $2 trillion by itself. Then there was a bunch of lending facilities and other things that they did. And so what has occurred over the last couple of months is pretty simple. We have seen a pandemic that caused an economic crisis, which then led to massive response from governments and central banks around the world. Now, in the United States, let's break down what have they done to try to stop or mitigate a lot of the damage. There's a lot of easy things like they have inflated asset prices by pumping liquidity into the market, right? There was a liquidity crisis. Everyone got nervous and scared. They wanted dollars. They started selling all their assets. The dollar got strong and all the asset prices went down. So when you pump liquidity into the market, all of a sudden you're trying to stabilize prices, stop them from falling, right? Make it easier for people to get dollars. And so they essentially did that, and they did it pretty well. And what I mean by that is they created all sorts of lending facilities. So if you look at the repo markets, they started to buy corporate debt, government debt, right? They did everything they possibly could to stuff money into the system. Well, look at what has occurred. Well, after there was about a 30% drop in public stocks, we have now seen a massive rally, including seeing their NASDAQ hit an all-time high again, right? Companies that have 3 and 4x in value, like the Teslas of the world. We've even seen bankrupt companies that have exploded in value in the public markets. And so obviously the mitigation or the stoppage of the sell-off in stocks occurred. And then we saw this massive rally. Now, along with what I will call the stock market manipulation that has gone on, right? You can debate the merits again, good or bad, it happened. We also realized, wait a second, there's a lot of people that are going to lose their jobs. There's a lot of small businesses that are not in the public markets that are going to need help as well. And so this is where a lot of these monetary stimulus efforts came in, or this relief came in. And so we started with individuals. There was an additional $600 per month on the unemployment front to help people who are going to get on unemployment. So they're going to file for unemployment insurance. They were going to get that insurance plus an additional $600 a month. This created a situation where many people were actually making more money on unemployment than they were off of unemployment back at their jobs. Now, that's actually probably more of a statement in terms of we weren't paying employees enough to begin with, but that's what occurred. So there's $600 extra a month. Then what we said was we're going to create the Paycheck Protection Program, the PPP loans. These are essentially very low interest rate loans that could be forgiven if you follow certain guidelines. Part of those guidelines were you had to be a small business or you had to prove that you were affected by the pandemic. You then could take the loan. And then if you essentially, in a very overgeneralized manner, if you promise to not fire your employees or to dock their salaries for an extended period of time, let's call it until October 1st, then you would not have to pay back the loan, right? Now, there's nuances, but that's generally what happened. Well, a lot of people, hundreds of billions of dollars was applied for and granted, and people received the PPP loans. These small businesses received them. We then also saw stimulus checks go out. So I think it was over $100 billion in stimulus checks were sent directly to people. So this is up to $1,200, a one-time cash injection to try to help people kind of get over the hump. And if you remember, kind of infamously, the Treasury Secretary said $1,200 should last. I think he said it was like 3 months or something crazy. And so that was kind of the idea was let's get liquidity directly in the hands of the people. So you've got a beef up of unemployment. You've got the PPP loans, and then you've got direct stimulus checks. On top of those three measures, we then saw bailouts of specific industries. So the airline industry, for example, they received about $50 billion in bailout money. That $50 billion, 1/3 of it is sent as a low cost or low interest loan that has to be paid back. 2/3 of it was essentially free money. There was no equity in exchange for it. There was no promise to pay it back. It was a grant of capital that said, if you do not fire your employees, you guys can just have this money. So all of that sounds great in the sense of the government, one, realized that there was a problem. Two, they immediately realized they were going to have to step in and intervene in the markets. Three, they went back and looked at the 2008, 2009 playbook and decided they were going to use that playbook again here. And they actually moved pretty quickly, right? For a government, in a matter of weeks, they were able to put together a multi-trillion-dollar stimulus package and get it into the market. Now, we can all debate, should they have done it faster? Should there have been better optimization, more nuance? Of course. But if you are going to do this, speed and kind of decisiveness is what matters. And generally, they did a good job. So now, all of a sudden, we are 4 to 5 months later, right, from kind of when the pandemic started. And what we see is a complete dislocation in the market between economic reality and asset prices. And I'll give you two core examples. The first is obviously stocks. So we have stocks that are hitting all-time highs. They're exploding in value, yet all of the underlying economic data suggests that actually GDP is down. We are in a full-blown recession. We are seeing businesses shut down. We are seeing record levels of unemployment. All of the economic data is bad, but stocks are up. Why is that? Again, there's artificial intervention and manipulation of stock prices. You can debate whether that's good or not. That's what's occurring in the market. The injection of liquidity into the market is going to devalue the dollar over some period of time, and it is going to inflate asset prices, right? There is no way that a company's revenue drops 90+% in, let's say, the movie theater industry. In some cases, there was 80-90% loss in revenue in the airline industry and the cruise ships, all this kind of stuff, right? There's no way that it drops 80-90%. The stock drops 60 to 80%, and then all of a sudden it rallies again 50% up. That just it doesn't match what the economic reality is. And so that dislocation is very heavily driven by the manipulation and intervention by the government in the market. Good or bad, who cares? That's what's occurred. Now, the second place that we're seeing an incredible dislocation between economic reality and actually the actual asset prices is in the residential home market in the United States. So most people would think when there's an economic crash or an economic recession, all of a sudden home prices should drop significantly and there should be no deals getting done, right? If you see like a Sam Zell go on television and say, hey, in the commercial real estate market, there's no deals being done. The sellers are still attached to their pre-pandemic prices. They believe their buildings are worth what they thought they were worth back in January and February. They have not yet accepted the fact that the pandemic has changed the market, and therefore they're not coming down in price. The buyers are expecting a big discount. And so you don't have kind of a market there because there's a difference of opinion. So no deals get done. Well, in the residential market, though, that's not what is occurring. Instead, the exact opposite is occurring. Home prices are going up, and we're seeing a plethora of activity in home sales. Why? Two things. One, we are seeing incredible low cost, cheap capital flooding residential homes, right? Interest rates have been dropped to zero in terms of the federal interest rate there. And also, when you have access to cheap capital, what do people do? They strike, they refinance their home, they try to go buy homes, all that kind of stuff. And so you have that trend going where just cheap capital is flooding the market, and people don't think that that cheap capital is going to go away anytime soon. The second thing you have is people are looking around and saying, wait a second, why do I live in San Francisco? Why do I live in New York City? I can go and spend the same thing I spent on an apartment and go buy a 3-bedroom nice home with a yard somewhere else. And so you get a lot of kind of migration out of major cities into these other areas. Now that trend will likely continue and actually accelerate over time, but we've already seen the start of that. The combination with the cheap capital you get is lots of deals being done. On top of that, many people don't know, but the US residential real estate market is actually at a deficit in terms of production every year. So if you look at how much demand there is for new home building or for purchasing of homes, and then you look at what the US actually produces every year in terms of new homes or onto the market, we produce a 200,000 to 250,000 home deficit every year, meaning we don't produce enough homes in order to satisfy demand on an annual basis. So the stat that I saw was 200 to 250,000 homes is the equivalent of basically a city like Miami. So every year we produce whatever number of homes we produce, and then we need to actually produce an entire city like Miami's worth of homes in order to satisfy demand and kind of have a net, have it net out without a surplus or deficit. Because we don't do that, that means that there is a deficit of supply. And if you have increasing demand and supply can't keep up, naturally you're going to see home prices rise. So that's what we're seeing is you see kind of anecdotally around the country, people are saying, wait a second, I listed my home and I had 6 offers for it. Or I thought we were in a recession. Why are there 6 offers? Well, 1, you have a deficit of home supply. 2, you've got cheap capital. And 3, you've got a lot of migration going on. And so the dislocation, again, there's 40 plus million Americans that have lost their job in the last couple of months, yet home prices are actually increasing and the market is having incredible efficiency in terms of getting deals done, right? You're seeing record level of home prices actually, or home transactions occurring. Now, couple that also with in the month of June, we saw 17.5+% increase in construction. Where's that coming from? Well, 17% increase in construction is actually a misleading number. So it's not so much about, is that a year over year number? That is a month over month number, meaning that a lot of states actually shut down construction in the months of March, April, and May. They started to come back in May, and then June we saw about almost 20% increase in construction. That's simply reopening. We're still down year over year on the construction side, but home prices continue to rise, transactions continue to go up. So we've got stocks, and we've got residential homes in the United States. Both of those are trending as if we are living in good times, yet the economic reality tells us we're living in bad times. How does this end? Well, here's where I think a lot of people are not yet paying attention. There's a ton of people who back in March and April were freaking out, right? They didn't know what happened, the uncertainty, the fear, the chaos. There was just this feeling of like, oh my God, what's going to happen? The blood was in the street, if you will. Stock prices sold off 30%. Gold was down almost 15%. Bitcoin on one single day dropped 50%, right? Everything froze. No commercial real estate deals being done. Residential completely froze. All kinds of things happening in the private startup and technology world. Deals immediately, term sheets getting pulled, just absolute chaos and uncertainty. Well, now we fast forward 3 or 4 months, everyone kind of feels okay. right? Not everyone feels great, obviously, because there's still a ton of unemployment, GDP's down, right? The virus is still there. We're wearing masks, all that kind of stuff. But the stock market's up. Residential homes are getting sold at record levels. So everyone's kind of saying, wait a second, like maybe it's going to be okay. But the thing is that we are riding the high of the monetary stimulus. So I always give the example that the US economy is like a crack addict, right? And the crack addict, if you think about it, at one point an addict never had crack before and they were living their life. Somebody one day says to them, hey, you should try some crack. And they try it and they get high and they kind of like it. And so a couple of days later, they try it again. And this time they like it again. And so they do it again and again and again. And eventually their body begins to get used to the amount of crack that they're taking, right? It's a scientific kind of chemical reaction in their brain. So now all of a sudden they're used to the certain amount of crack that they started taking. Well, then to get that same high that they got originally, they have to take more later on, and then more and more and more. And eventually, if they completely get out of control and abuse it, they actually end up overdosing and dying. And so that's how a kind of the evolution of a crack addict works. But they have to take more crack over time to get the same high. The economy is no different. If you go back, right, we've had to inject more monetary stimulus over time in order to get the same high. So in the 2008-2009 crisis, when we decided to step in and intervene in the markets and kind of artificially mitigate the economic damage and kick the can down the road on the structural issues, what we ended up doing was simply just getting high on monetary stimulus. But it only took us hundreds of billions of dollars at that time. Fast forward now, 10, 12 years. And now during this economic recession, we have to do trillions of dollars in order to get the same high off the monetary stimulus. So we are no different than a crack addict who's addicted to crack. We are simply addicted to monetary stimulus, which is fine. The problem, though, is just like a crack addict's high eventually wears off, and then you have kind of coming off of that high. That's what happens with monetary stimulus as well. So we saw in 2016 and 15, 17, in that range, we started to try to actually raise interest rates and pull back and do some quantitative tightening and stuff. And we got gyrations in the market. So we know that that's not really something that the economy is used to, nor does it respond well to. But also what we know is in the short term, when we pump a ton of liquidity into the market, we then get ourselves in a situation where at some point it runs out. So let's go back to the monetary stimulus that we have that we announced and have kind of implemented over the last couple of months. Let's start with unemployment, for example. That's $600 extra, the beefing up of unemployment insurance per week for people, is set to end in July, at the end of July. If that ends, that means every single person, the millions of Americans that are unemployment right now, will start to make $600 less per month. Some people will still be able to survive on whatever the traditional unemployment insurance is. Some people will not. And so there is going to be a kind of reckoning in that market for people who are unemployed, and they're about to make $600 less a month. If you go through the math, or $600 less a week, if you go through the math, that's $2,400 less a month. That is a very material difference in how much money you are actually consuming or pulling in as income. Now, if you then go and you say, okay, well, that's unemployment. Maybe we should open up the businesses. We should get people back to their jobs. Well, we're also going to see all those people who took PPP loans. So the airlines, all those small businesses, everyone who took these loans that were forgivable as long as you kept your employees through to October 1st. Well, October 1st is coming pretty fast. And so we already see people like the airlines sending out to tens of thousands of their employees saying, hey, we are likely to cut your job at the end of September. So we are basically going to keep you on until we hit the kind of threshold that we need to make this loan forgivable. And then we're going to fire people. And it's not going to be we're going to fire 100 people or 500 or 1,000 people. There are certain airlines that are sending this to 25, 30, 50,000 employees saying that, hey, you're likely to lose your job. You should either quit the job now and go find a different one. You should take early retirement. You should take voluntary leave, all that kind of stuff. But when these PPP loans run out, and if the economy is not back to the point where businesses have enough income to actually support their customer base or their employee base, What are they going to do? They're going to fire the employees. And so we may get an entire second wave of layoffs simply because the PPP money is going to hit the threshold that they needed to actually then make it forgivable. So you've got unemployment benefits that are going to expire. You then have, within kind of 2 months of that, you're then going to see all of a sudden another wave of layoffs from the PPP money. And you sit there and you say, wait a second. And as of right now, there's no more stimulus money coming. So what are these people going to do? Well, we used artificial intervention in the market and manipulation of the markets in order to mitigate the damage. A lot of people are very happy that we did that. But what happens when it runs out? And that's what we're facing now. And so, again, you cannot have dislocation between economic reality and asset prices forever. Either the asset prices have to come down or the economic situation has to improve. Now, what the Federal Reserve and the US government has hoped would happen is that they could inflate and kind of mitigate the damage for long enough with this intervention so that the economic data could bottom, right? So it would drop, it would bottom, and then it would recover. And by the time the effects of the monetary stimulus back into kind of pre-pandemic levels. Well, if you look outside, there's a lot of states that all of a sudden have reclosed certain types of businesses. They went through all of the shelter in place. They began reopening. The virus cases exploded. And then all of a sudden, now they're starting to reshut the bars, the restaurants, all this kind of stuff. This doesn't appear like it is going to go away anytime soon. It may, but it doesn't appear like that's going to happen. And so we've got a second perfect storm occurring. We have unemployment benefits expiring. We've got PPP money that is going to allow people to start firing their employees in the next couple of months. And then we have what looks like a economy that is not going to reopen how everyone thought it was going to reopen. And so it is likely that that economic data is going to stay bad or not ideal for a long period of time, right? GDP could still continue to be negative into Q3 and Q4. If that occurs, I don't think asset prices can stay inflated forever. And so what you have to start to ask yourself is, wait a minute, let's zoom out for a second. We're only 4 to 5 months into this economic recession. If you go back to 2008, 2009, or any recession previous to that, how many recessions were only 4 months long? Not very many, right? If at all any. And so people have this feeling that things are going well. Everything is being okay. Asset prices are starting to rise. But don't be fooled. Don't get high on the monetary stimulus supply. Remember, we are in an economic recession. We just saw a massive liquidity crisis in which the Fed decided to step in with trillions of dollars and try to mitigate. But what it is doing is it's masking the economic reality. And again, they may be able to pull it off, right? They may be able to pull off the magic trick of let's mask the economic reality, let's inflate asset prices. It'll give it time for the economy to come back. But if they cannot, what actually ends up happening is they may have caused more damage in the medium term. Meaning that masking of the reality simply saw stocks drop 30%. They then explode asset prices. And what if we get a market correction in the future? Again, I don't have a crystal ball. I don't know what's going to happen. But it's pretty clear that if the monetary stimulus cannot last long enough for the economy to recover, there would likely then be a correction in the market. That's in homes, that's in stocks, that's in every asset class. If that occurs, this would have been one of the most incredible dead cat bounces in the world and in history, because what we saw was such a manipulation of asset prices. And so I think that people just have to remember, look at the underlying economic data. We have to understand, is that going to recover in time, or is the monetary stimulus going to wear off before that? Now, there is a variable here that could change all this analysis. That variable is there could be more economic stimulus or monetary stimulus on the way. So if you look at both the Democrats and the Republicans, they all want to create more monetary stimulus. They just can't decide and agree on how they should do it. So you see things like Donald Trump saying and his administration saying, hey, we should send more stimulus directly to the people, and it should be more than $1,200. You see on the other side, there's been proposals from the Democrats of $3+ trillion stimulus packages. Right? You've seen people on both sides of the aisle say, hey, maybe we should actually extend those unemployment benefits so they don't expire in July. Maybe we should extend them to the end of the year, or maybe even into 2021. We've seen people who said, look, the PPP money, maybe we should change some of the information there. We've even seen proposals for things like UBI, where people have come forward and said, we should just start giving people $2,000 a month, right? And just continue to do that until we reach pre-pandemic levels of economic output for our country. Now, I don't know what's going to happen, but unless there is more stimulus on the way, we are starting to see on the horizon when some of the stimulus effect will wear off. Unemployment, end of July, PPP, end of September, right? You start to see as we get closer. My guess is that there is going to be more stimulus. And when that occurs, I also believe that we now have representatives and a Federal Reserve on all sides of the aisle. So there's two parties and there's a bunch of independents. They all are emboldened. And the reason why they are emboldened right now is because they've seen that they can, quote unquote, get away with it. They did a $2 trillion stimulus package and have zero concern about any sort of inflation. Literally, the Federal Reserve Chairman Jay Powell went on television and he said, we're not even worried about inflation right now. Right? When asked if he was going to move interest rates, he said, we haven't even thought about thinking about moving interest rates up again. So this is something where they feel like they've got command and control of managing an economy, and they can do all sorts of unprecedented things in order to manipulate the economy. Well, we better hope that they're right, because if they do things that don't work, we're the ones who are going to feel the pain. And if you go as far as to understand, okay, if they start to do some of this stuff, remember what I said back in, I think it was March or April, the unemployment, for example. Who's going to be the politician who says, I'm taking away your $600 extra a week unemployment benefits, especially in an election year? I just don't see that happening. I don't think that they can do that. Either political party. You're going to have, again, millions of Americans that you're going to take money away from. It's political suicide. And so I think you're going to see the extension somehow, some way at the end of the month. I could be wrong, but we'll see what happens there. In terms of more stimulus checks, there's nothing more powerful for a president who is up for a re-election than to send money directly to people in their bank account, right? This is the whole idea of Trump bucks. There's literally a political incentive to do it. So I think that we will see some sort of package get put together in Q3 and go ahead and go out. And so it's hard for me to see a pathway to an economy where the economic data reigns supreme over the manipulation of the assets in an election year, right? It is probably one of the things that the incumbent political party can hang their hat on, is if they can continue to pump asset prices and say to everyone, what do you mean? You got to vote for me. I'm making you rich, right? Asset prices are going up. But the long-term impact of this, as we know, is the bottom 50% of Americans get absolutely crushed by this type of manipulation. When you flood the market with trillions of dollars, you cannot believe that you are not going to devalue the dollar. And when you devalue the dollar, 45% of Americans don't own a single stock. 50% of Americans cannot come up with a $400 emergency payment. So all they do is they live paycheck to paycheck, and 100% of their wealth is sitting in cash. And you are going to absolutely ravage their net worth, their savings, and you are not only going to hurt what they already have saved, the little bit that they have in terms of sitting in cash, and take away that purchasing power, but on top of that, you are also going to make it so they make less money, right? One of the hidden thefts everyone knows is inflation in terms of eating at your cash savings. But a second hidden theft is the fact that all of these people who are getting paid hourly wages, people in hospitality, service industries, et cetera, they may get paid $12 an hour. And they think they're getting paid the same amount of money year in and year out because they keep getting paid $12 an hour. But when you print this much money, the purchasing power of that $12 goes away. And so they're actually making less money per hour, plus you're eating away at their savings. You are going to completely decimate the bottom 50% of Americans, and you are going to extend and accelerate the widening inequality gap, right? If you look at the pandemic, who's made money? Billionaires in the United States have made hundreds of billions of dollars during this. Why? Because the government is bailing out corporations. The whole key to money and wealth is to not hold cash. You have to get out of cash. You have to get into asset prices. Don't fight the Fed. Don't believe that the Fed cares about the little guy. The Fed cares about managing an economy and pushing asset prices. If you go and you look at the stock market and you zoom out over the last 30, 40, 50 years, and you zoom out, it looks like a 45-degree angle. Sure, there's volatility in there. It's a 45-degree angle up and to the right. Why? because structurally, stock prices are going up over long periods of time with nothing to do with the underlying companies. It has everything to do with the fact that the dollar, the denominator, the thing that the asset is denominated in, is being devalued. Many people will say you're crazy. Well, am I? If you take that same stock market and you denominate it in gold, the stock market is down since 1971. So the stocks actually have not increased in value if you denominate in gold. But if you denominate in dollars, it looks like a 45-degree up and to the right. There is a devaluation of currency. The whole secret to building wealth is to get out of cash and get into assets that are denominated in dollars. They will continue to go up in value over long periods of time. Stocks, real estate, gold, Bitcoin, all this stuff. The dollar is being devalued. And so that's what we're seeing happen here. The problem is that 50% of Americans, the bottom 50%, they don't have financial education. The system is built based on the idea that 50% of people don't understand how money works. They don't understand how the economy works. And so they get hurt while the rich get richer. And so what I believe is likely to occur if we were to see unemployment benefits go out and not be renewed or extended, if we were to see PPP expire, have all of the businesses fire those employees and no more stimulus come, if you thought that the civil rights and the individual liberties and personal freedom and the racism and the police brutality, those protests were bad, imagine when people say, I don't have money. On top of all of those things, right? There will be incredible unrest. And so this is a thing where I just don't see us getting to, in an election year, getting to November without any sort of continued monetary stimulus in the market. So I'm going to keep going for about 2 or 3 minutes. If you can, take all of your questions, put them in here. I'll go back and I'll try to answer as many as I can. I'll hang out for about 30 minutes or so. But one last thing I want to say before I start answering questions is I personally believe that the most important thing people can do right now is understand that the recession is not over, right? We are only 4 or 5 months into this thing. And so there's all sorts of chaos that is still on the horizon. And that may happen in the next 3 or 4 months if they let all of the monetary stimulus expire, or they could extend it even further. But there's no way that this is over in the sense that all of the economic situation is resolved. What we are getting is we are getting tricked by looking at stock prices into thinking things are okay. But the economic data is really bad. And so I'll leave you with a story before I start answering these questions, which is yesterday I went and I had lunch at a place in New York City, right? It's a little small hole in the wall place. The small business owner or restaurant owner, he is the owner of the restaurant. He helps to serve the food along with a couple of employees. He's also the cook. He's from Spain. He has a number of businesses in Spain, but he also owns a restaurant here in the United States. He lives here. He traditionally goes back to Spain every quarter, but because of all of the issues, he hasn't been back obviously this year. And so I was sitting there eating lunch with Pompliano, and I said to him, I said, hey man, how's it going? I see him every day, right? And he looked at me and he goes, I used to serve 80 tables every day for lunch. He's right around near the UN building. There's a bunch of office buildings. All of those people used to come into his restaurant. He used to have a line outside, 80 tables that he would do every single lunch. Today, he is averaging 6 tables. That is what he's averaging. It is a complete decimation of his business, more than 90% loss in terms of the customer base on a daily basis. That guy is struggling. And if this goes on for too long, that man will not make it. His business will not make it. And so I still believe 20 to 25% of small businesses in America, unfortunately, are not going to make it. They're not going to make it out the other side. And if that occurs, small businesses are responsible for 50% of jobs in America. If 20 to 25% of businesses went away in the small business sector, that means 10%, give or take, of American jobs would disappear through this. It would take us a decade or more to get back to having that type of job growth. And so the damage and the long-term scarring that we are likely to have from this cannot be overstated, right? You have to understand we are still in a recession. Do not get tricked by the monetary stimulus. Do not buy into the high that we are getting from that. It is still incredible economic carnage on the small business level, even at large corporations, right? And so this is likely to continue for a long period of time. So be patient and make sure you are prepared. All right. I am going to go all the way back and start answering questions. Fire as many of them as you can here. Before I start this, please remember to like the video. There's a little thumbs up button. Punch that so more people can watch this. And then also make sure you're subscribed to the channel so when I do these, you get a notification. All right, let's see. Bitcoin. Let's just get Bitcoin out of the way. So Bitcoin's doing exactly what I would expect it to do, right? Earlier this year, everyone was yelling and screaming, saying, wait a second, Bitcoin should thrive in this situation. But as I've explained many times, there was a liquidity crisis. No matter what the asset is going to sell off if there's a liquid market. So investors are sitting there, they say, I'm scared, it's uncertain future, I need cash. I'm going to sell anything I have in my portfolio that has a market attached to it. And they dump it with such aggressiveness that the prices drop because there's such an overwhelming of sellers in the market. And so you saw stocks go down, you saw gold go down, you saw Bitcoin go down, everything went down. Correlations trend towards one during a liquidity crisis. Go back to 2008, 2009, gold went down almost 30% during 2008, the summer of 2008 during the liquidity crisis. And then once the Fed started to pump, you saw this massive rally, almost 200% increase in the price of gold, hit an all-time high in 2011. I think that's exactly what's happening here, is you saw all the asset prices drop down. Then all of a sudden the Fed stepped in, they started to pump asset prices. You've seen stocks explode, gold explode, Bitcoin explode, et cetera. The key though is Bitcoin is going to be the fastest horse in the words of Paul Tudor Jones, right? That's why he put 2% of his net worth or of his assets into Bitcoin. It's because Bitcoin's the most volatile out of them. The way volatility works is it works against you on the way down, right? Hyper volatile. It dropped 50% in a single day. During the kind of deep liquidity crisis, it went down over 30%. But on the way up, the volatility works for you. And so what you've seen is Bitcoin today is up like 35% on the year. So year to date, Bitcoin is up 30 to 35%. Gold is up, I think, like 15 to 20%, last numbers I saw. And then stocks are about flat. So you're going to see kind of the most volatile assets perform the best on the way up. I think over the next 2 to 3 years, Bitcoin will be the outperformer in terms of all asset classes or asset prices. So I'm not worried about kind of where Bitcoin is right now. It's actually pretty encouraging to see where it is, especially with the halving just occurred. I continue to think that when you have a supply shock like that combined with a demand shock that we're seeing, you're going to have this like rocket fuel over the next 18 months for the price of Bitcoin. Let's see here. Invest in China. So China's a really interesting one to me for a couple of different reasons. One, you have incredible geopolitical risk right now, right? Everyone has seen the conversation around TikTok, for example. So that's one of the companies that's kind of getting caught in all of the geopolitical and economic war with China. You also see kind of the Hong Kong debacle that's occurring where literally China has essentially taken the sovereignty of Hong Kong away. They've taken the freedoms of the Hong Kong people. And so China, to me, there is a strong argument for the demographics, for the consumerism, kind of for all of the population size, right? All of that stuff. There's a very strong argument. But there's incredible risk on the geopolitical side, on the economic side in terms of sanctions, all that kind of stuff. And then also you have communists. You have the Communist Party in China who is likely to do things that are just off the wall, right? What they did in Hong Kong was off the wall. I don't think anyone realized that was going to happen right before it happened. So when you see that type of stuff, you then say to yourself, it would be a pretty big risk to go invest in a place with so much uncertainty and also so much manipulation that can occur, right? If you look at something like Luckin Coffee, for example, complete fraud, all of a sudden it just blows up and everyone's looking around saying, wait, what just happened? Well, it was a fraud. So how much of the actual economic activity in China is real? It's up for debate. The other thing that I will say is if you listen to somebody like a Peter Zeihan believes that China as it stands today will not be around in a decade. It's a pretty aggressive statement, right? I don't know if I necessarily agree with that level of severity, but he believes that there will just be too much infighting and too much social instability, and therefore it would lead up to kind of a breaking up of Hong Kong or of China as a single kind of unified country. We'll see. I do think, though, that Peter is correct in that the demographics of the United States are one of the most attractive anywhere in the world. Yes, we are seeing incredible federal spending to help our elderly. So for those that don't know, the U.S. government has collected more federal tax income or revenue for the government every year for the last 6 fiscal years. So if you go all the way back for the last 6 years, the government continues to get more and more federal income revenue. Why then does the deficit on an annual basis, so not the total deficit, we're over $26 trillion on that deficit side. But every single year, the deficit we're running is getting larger and larger. Wait a second. How is that? How is it the government's taking in more revenue, yet the deficit is getting larger and larger? Well, it's because we continue to spend way more than we should. 40% of government spending goes to people over the age of 65. 40% of our spending goes to people over the age of 65. That is only going to accelerate. There's estimations by the end of the 2020s, the 50% of the federal government spending is going to go to people over the age of 65. And so that is a thing when you look at it, you say, demographically, that's kind of concerning. But also when you look at other demographics in terms of the median age and stuff like that, the U.S. is actually one of the best places in the world. Places like Nigeria in the African continent, other kind of attractive demographics as well. So I think that you've got to just be very, very careful in somewhere like China. The United States is kind of where I focus a lot of my time on, but I do think that there will be other places in the world. You just got to look at demographics and kind of understand the geopolitical situation that's going on. What are the questions that we have here? I'm seeing a lot of construction activity in the South with lots of deals, particularly in opportunity zones. Yeah, look, there's no secret that when cheap capital floods the market, there's going to be tons of building and there's going to be tons of construction and home purchases. Now, one thing that I will kind of separate here is you can't just paint the same brush across the United States in the real estate market. So take a place like New York City right now. New York City is actually seeing the median price fall for apartments. And also, it is seeing an incredible surplus of supply while that demand drops. Now, two factors are at play. One, there's a pandemic, obviously. And so there's a lot of people looking around saying, why do I live in New York? I should just move out. If I don't have New York as a city there, then really all I do is I have an overpriced apartment with not a lot of space. So you see people kind of leaving. Of course, that's going to have a impact on prices. Prices are going to come down because there's going to be less demand. The second thing you'll see in that a more structural kind of longer term trend is in the called 2010, 11, 12, 13, 14, 15, 16, maybe even into 17, there was this massive rise, right? Really to kind of 15 or 16, massive rise of foreign money flooding into the market. And so people from Asia, especially China, were coming in, they were just, throwing money around. They were buying up apartments, some for investment properties, some as store of value. Some were doing it because they actually wanted to live there. Some were buying it so their kids could live there. Whatever the reason was, there was massive influx of money from Asia and foreign investors. Well, developers and builders saw this and said, wait a second, let's build a bunch more homes. We can make a ton of money. Look at all this money that's flooding the market. There is a lag time in terms of the idea of I should build a building to actually being able to sell it, called 18, 24, sometimes 36 months. Well, as they started to build, all of a sudden, we then saw a peak of that foreign investment and started to drop off. So now you have all of this inventory that's coming online, but that demand's not there. And so you have this massive surplus. That's where you get the median prices coming down, and you get kind of not a lot of liquidity in the real estate market in New York City is because demand has disappeared and there's that surplus in terms of the inventory. That is not true in other areas. So in the major metros, that may be true because that's where most of the foreign investment was going. But in areas like the Southwest, for example, in the Southeast, across the Midwest, you still see incredible demand because cheap capital is flooding the market. There's a bunch of migration trends that are working for you as well. So it doesn't surprise me that construction is kind of restarting as economies reopen. Like I said earlier, June saw 17% increase in construction. So let's see here. Can you talk about what you think happens with the elections? It seems like whatever the outcome is, violence protests will be the response from the losing group. So I'm not necessarily concerned that there will be violence. There's definitely going to be protests. I mean, if you remember when Trump was elected, there was protests. But what I do think is really important here is I come from a position that all politicians are the same. And before everyone gets upset about that, what I will say is the political position of president is near impossible job, right? You basically go in wide-eyed, bushy-tailed with all these ideas and you're going to make all this change. And then you get in and you realize that the bureaucracies and the mechanisms of the checks and balances of the government make it really hard to get things done. And so there are two things that you cannot argue about our last two presidents. President Obama got a lot of things done. You can argue the merits of whether they were good or bad, but he got a lot of things done. Donald Trump has actually gotten a lot of things done. You can argue the merits of good or bad, but again, both presidents have got a lot of things done. And so they've chosen to take a position of executive orders and kind of, I'm going to dictate this to the government and then have the government respond with checks and balances, things like that. Now, what I do believe is an entire generation of people are growing up and they're realizing no one is coming to save me. There is no president. It doesn't matter who the president is, Joe Biden or Donald Trump. It doesn't matter. I have to look out for myself. No one is going to look out for me the way I look out for myself. And so I think that's going to change a lot of the way that people think about politics. I think it's also going to change the way that people kind of act, both as an investor, as an entrepreneur, or as an employee at a business. So with that said, if you look at what Donald Trump's basically saying is he's going out and he's saying, hey, look, I'm going to continue to remove regulation. I'm going to continue to drive taxes being taken away, right, and kind of get money into people's accounts. I'm going to kind of hang my hat on the stock market going up. All of these economic things, that's a very kind of conservative or Republican-driven narrative. On the other side, you have Joe Biden saying, literally, he's going to create this massive tax plan, right? He's going to increase taxes, kind of all that kind of stuff. Again, neither one of these is the right solution. And here's why. I don't believe that the government is a good allocator of capital. They're actually a horrible allocator of capital. And so if you look at what an entire generation of people just saw, the Federal Reserve went into their bank account, right? The Federal Reserve's balance sheet, and they edited the number. They were on 60 Minutes bragging about the fact that they have unlimited liquidity, unlimited money. And so if you can go into your bank account, you can just edit how much money you have. Why do you need my money for taxes? Why do you need to take money from my business or from my employees or my friends and my family? If you can just edit your bank account, why do you need my money? I can't edit my bank account, but you can. And so I think that's what we're starting to see is people are waking up and saying, wait a second, this is a racket. Right, I've always said that the virus is exposing the shams in society, which is the Federal Reserve doesn't need our money. They can create more of it, and they're financially incentivized to create more of it. The Federal Reserve's balance sheet has increased by 75% over the last couple of months. 75% they increased it. Trillions of dollars, over $3 trillion they expanded their balance sheet by. Why do they need our money? They have their own money. They can create money. They have the ultimate power. I think there's an entire generation that's waking up to that, and they're going to start writing off a lot of these politicians saying, listen, it doesn't matter what your plan is. I got to look out for myself. I also think that there is a very serious popularity contest going on in politics now where it would not surprise me. I've said this a million times. The Rock, I believe, at some point will run, and it would not surprise me over 20 to 25 years. I think it will take 20, 25 years. But at some point, we will see Kim Kardashian take an attempt at running. I actually think that both of those people have a shot of getting a nomination. I don't know if they actually have a shot of winning the presidency. But given where we are in politics today in terms of this popularity contest, they're two of the most recognizable figures in the world, not even in America, in the world. And so I think both of them would have a shot at winning the nomination. Not saying that they should get the nomination, not saying that they even would be good candidates or good presidents, but I do think that that's kind of structurally where we are in American politics now. I've said over and over again, whether people like it or not, whether I like it or not, I think that Donald Trump wins in an absolute landslide in November. And you kind of have two forces at play here. One, he has the position of power in the sense that he's able to manipulate the economy and continue to do things to make it look like he has everything under control. And essentially, he can make everybody who is in the wealthy and elite class, he can make everybody more wealthy between now and November. That's why you can continue to see stock prices going up and all this kind of stuff and cheap capital flooding the market. That ends up being a plus in the category or in the bucket for the incumbent. And then also, I just don't think that Joe Biden is necessarily the strongest candidate that could have been put forward. Again, doesn't mean that he couldn't do a good job as a president, but when you look at kind of the field of candidates, I think there's a lot of Americans, whether right or wrong, who are saying, look, we basically have 270-plus-year-olds who are running for president. Like, if I got to pick one or the other, like the guy who is going to make me rich rather than take more taxes from me, I'm going to go with him. That's my opinion on it. Again, I am the ultimate independent, which is I frankly think that the two-party political system is really stupid. So we'll see what happens. But that's enough about politics. There's an old saying, there's nothing more permanent than a temporary government measure. Could not agree with this more. My whole argument in terms of UBI, for example, I do think that we will see UBI at some point in the next 5-6 years in the United States. It wouldn't surprise me to see it coming out of this crisis. Once it gets started, they'll never be able to take it away. And so if you see them go ahead and announce, hey, rather than a one-time stimulus check, we're actually going to do a monthly check, whether that's $500, $1,000, $2,000, whatever it is, they won't be able to take it away. Political suicide for any politician who implements UBI. For a future politician to try to take it away from people. They feel like that is their right now. They feel like you're taking away government benefits. And so once we get there, I think that it's going to be pretty crazy. So So in terms of Tesla, I see a bunch of people asking me about Tesla. I think Tesla is really interesting for three reasons. One, the market, whether you agree with it or not, has proven one side of that argument correct. And I put it in air quotes in the sense of if you were short Tesla at $200, $300, $400, what you realize is that even if you believe you're still right, the market can remain irrational longer than you can stay solvent. And so you just saw, from $200, it was trading at $1,600 the other day. It went up 8x. So whether you think you're right or not, the market just disproved your theory that the stock was going to go down. Doesn't mean that you're not right in terms of the company, the financials, whatever, but you were betting on as a short seller that the stock price was going to go down and went up 8x. You were wrong. Now, what that brings into question is, okay, what happens next? And so there's two schools of thought here. There are a lot of people who invest in the public markets and they look at things and they say, hey, I'm going to look at the financials of a business. I'm going to make investment decisions based on those financials and kind of short-term price movements. I believe that Tesla at $1,500 is going to go up or down in price. I'm going to make investments based on that. There's another group of people who I look into, right? I don't invest in the public markets, but the way I look at investing in companies, and if I was a public market investor, I would look at something like Tesla, is I would say two things. Do I believe that electric cars are going to become more valuable and gain market share in the future, or do I think they're going to gain less? I think that at some point in the future, electric cars are going to be the market. So you're going to see gasoline-powered cars go away. I don't know if it takes 10, 15, 20 years, but electric cars will be the standard in the future. Okay, so you have a trend which Tesla would benefit from. They have wind at their back. The second thing I would say is Tesla the best electric car maker on the market? Yes, hands down, no question about it. And so if you have a trend of an industry where it is going to go from a small market share today of car sales or electric to the dominant or the standard of the majority, then obviously you would want to, okay, who's the leader in that industry? Tesla. I think that Tesla will be worth more money in the future, meaning 5, 10, 15 years from today than it is today. Now, what happens between now and 15 years? There'll be incredible volatility, right? Go back to Amazon stock. Amazon stock, since it went public over 20 years, every single year has had a double-digit drawdown in the stock price. The intra-year average of that drawdown is over 30%. So if you held Amazon stock from the IPO to today, every year it's dropped 30% on average, right? At one point it dropped 90%. But because innovation, it drives volatility, right? And volatility goes hand in hand with innovation. It was such an innovative company that you got all of this crazy volatility. But if you held the entire way, it's one of the best performing stocks that we've seen in the last 20 years. Tesla is likely to do the same thing. It's super volatile, of course. It's a highly innovative, disruptive business. If it ends up being successful, right, and he does make it 15 years, my guess is that it is going to be the leader in electric vehicles and it'll continue to gain in value. If you want to bet on short-term price movements and that's your game, you think you have an advantage there, knock yourself out. If you want to bet on long-term trends and you're a long-term holder and you're not going to, trade and all that stuff, then hey, that's your thing too. But you've got to separate this idea of short sellers versus long-term investors. And ultimately the market is the referee there. And so far the short sellers were disproven. Doesn't mean that they can't be right in the future, but so far the market has said that those that were long Tesla have been correct and those that were the short sellers were wrong. Let's see here. What else do we have? Trusting billionaires. All right, that's a great one. So somebody said the only billionaire that they trust is Peter Thiel. Look, at the end of the day, when you look at the billionaires in America, yes, there are plenty of them that inherited their wealth. But the majority of people who are first-time billionaires in their family, they are some of the most innovative, intelligent, creative people in the world, right? And so I personally believe that we should encourage as many billionaires in the world as possible. If there's 400 or 500 billionaires in the United States, we should hope that there's 5,000 billionaires in the United States. Because what that means is that we are leading the world in innovation, in creativity, in production, right? And manufacturing, all this kind of stuff. Being a billionaire means that you created $1 billion or more of value in the world. Now, you can argue whether that's a good thing, a bad thing, whatever. But at the end of the day, that's how you become a billionaire. You created value and you captured that value. How you did it is up for debate, whatever, but we should want as many billionaires in the world as possible. I actually hope that every single person, there's 1,000 people watching this right now. I hope you guys are all billionaires, right? And by the way, if you can't be a billionaire, then being a centimillionaire would be awesome, right? $100+ million. And if you can't do that, then become a millionaire. Or if you can't do that, become 100,000-aire, right? We should want to see people become successful. And what I hope occurs is that we can get into a world where, one, there's this feeling of, hey, I want to give back. And so you see things like the Giving Pledge where people give away 99% of their wealth, right? They spend a lot of time employing people, all that kind of stuff. But also, too, is we can change the structure of how the system works. And that to me is why I'm so excited about Bitcoin, right? Is you don't have to be in this inflationary system where people end up getting screwed by the system. They end up getting in a situation where they can't get ahead. But at the end of the day, we should want as many billionaires in the world as possible. And we should also want to see every single person succeed. But you've got to have a system that sets up for people to do that. Are there bad people as billionaires? Of course. Are there good people as billionaires? Of course. I don't think being a billionaire makes you good or bad. It's kind of like, what do you do with the power and responsibility once you get it? Let's see here. UBI will unleash creativity and innovation as people are no longer living hand to mouth. It's a minimum stipend, not an invitation to stay on the couch. From Ben. Yeah, look, again, UBI is a highly controversial topic. The short answer is we don't know what UBI will do, right? There's not enough data to understand the impacts of UBI. I am not here to debate the merits of it. It's more of, I just think it's going to happen, right? Whether we like it or not. And they may call it UBI. They may call it modern monetary theory. They may call it, money raining from the sky. Like, it doesn't matter what nomenclature you put on it. It's just the fact that the government is incentivized to continue to give benefits and money to people. And I think that's what's going to happen. And so how people use that is a whole nother situation. Peter Schiff, look, the gold community, as I said before, the gold investors have been right in terms of the structural issues with the economy. Peter Schiff, a lot of people give him a hard time in the crypto community, but Peter was right about the 2008 crisis. He's been right about a lot of the structural issues in the economy. We agree, meaning me and him, we agree on, 75, 80% of the things he says, like all the issues that he identifies. Absolutely, for sure. I actually agree with him that gold will benefit from the economic situation that we're in. We've seen gold go up. It's gone up more than stocks, for example. And if there continues to be high levels of inflation, gold will continue to benefit there as well. I just personally think that Bitcoin will benefit more than gold. So it's not, to me, a binary thing, gold versus Bitcoin. It's just that Bitcoin is going to outperform gold, but gold will still do well. So Peter and I are absolutely fine. We talk, every once in a while, and I tend to think that he's a good dude. And look, he likes to troll people on the internet. Fine, whatever. Have a blast. He's having fun. And people troll him back. So he's kind of engaging, and you guys are just doing what he wants you to do. Now, one thing on inflation that I will say that I don't know if a lot of people saw, Marty Bent wrote about this week that I thought was really interesting, is if I remember correctly, I think it's the St. Louis Fed chair. It may have been Boston. I can't remember. But somebody at one of the Federal Reserve said that they're not worried about inflation. They actually think that we should hit the 2% inflation and potentially overshoot our 2% inflation target before we start worrying about inflation. Rewind that. Hear what I just said. They were talking about inflation, and because we were printing trillions of dollars, they were essentially asked, are you worried about inflation? Jay Powell said, I'm not worried about inflation. We'll worry about that down the road. This person said, we shouldn't worry about it. We should at least hit our 2% inflation target and potentially overshoot it. When I hear inflation, what I hear is we are going to steal the wealth of the bottom 50% of Americans. That's what is occurring. And we can talk about how it pumps asset prices and does all this stuff, and it's supposed to spur economic activity. All that other stuff is fine. But when I hear that we're going to overshoot 2% inflation, that's the CPI metric. Remember, coming out of 2008, 2009 crisis, we never saw the high 3-4% inflation that everyone thought we were going to see in the CPI metrics. But if you go and you actually look at inflation, you say, wait a second, everyone's inflation level that they experience is not the same. So one person may be experiencing 1.5% inflation. Another socioeconomic class may be experiencing 6% inflation. There's a number of studies that have come out of both the United States and Europe that show that actually some people coming out of the 2008, 2009 crisis had 6 to 10% inflation. But that's not what the narrative is. The CPI metric doesn't say that. But again, if you don't have all of your wealth in cash and you're not living paycheck to paycheck and you have an inflation-adjusted wage contract, of course the inflation that you experience is going to be much lower than the person who isn't protected by an inflation-adjusted wage contract, doesn't have any assets, and is living paycheck to paycheck with 100% of their wealth in cash. So when I hear that they want to overshoot the 2% inflation target, one, that means that they are actually going to be aggressive enough to hit it this time, or they want to be. So we're going to have more stimulus on the way. We're going to continue to devalue the dollar. And that means that the people at the lowest end of the socioeconomic ladder, they're going to experience double-digit inflation. Double-digit inflation. What is the difference between us and Lebanon, us and Venezuela? We may not hit true hyperinflation, but if you're living in a world where you experience 10% or more inflation, and you literally feel like you can't get ahead, you're getting paid in cash and you're watching your wealth be devalued? What's the difference? There's not that much difference. In Lebanon right now, 85% loss in the value of the currency against the dollar. And then when people see that their currency is being devalued, most people don't understand economics. They don't understand how money works. They don't understand what's going on. All they know is that price of bread just doubled overnight or in a week or 2 weeks. Why is the bread twice as expensive as it was yesterday? Well, it's because my currency buys less of it. And so what do they say? Well, get me out of the currency. No brainer. But they go to the bank and the bank says, hey, you can't withdraw more than X dollars or X of your local currency. There's a capital control. You can only take out so much. And by the way, you have to pull it out in our currency. You can't pull it out in US dollars or any other foreign currency. You have to pull it. You're locked into our currency. So what it does is it creates this massive black market, Bitcoin selling at 2x the value of Bitcoin elsewhere, right? Or people wanting to get dollars and all this kind of stuff. And so what you see is that the currency drives social unrest. They literally were lighting banks on fire in Lebanon. Why? Because they were trapped in a currency, and the people at the lowest end of the socioeconomic ladder got hurt the worst. Now, that's an 85% drop in value of the currency. I don't think we're going to see that in the US dollar, but I do think we're going to see high levels of inflation for the lowest socioeconomic classes. I do think it will lead to social unrest at some point. And I do believe that we are going to see an ever widening inequality gap that is going to go on steroids. If you look back since 1971, it basically looks like this, right? It's like 45-degree angles to the up and 45-degree angles down for the poor. So rich get richer, poor get poor. I do believe that we are going to see that massively increase. You cannot print trillions of dollars and not expect an impact on the back end. It's just not possible. So we'll see what happens there. Could you please comment on the merits of printing money? How will this work with cryptocurrency? Yeah. So for those that have never heard this, I'll take 2 seconds on why I am so bullish on Bitcoin, right? I believe there's two financial systems. There's the legacy financial system. It's inflationary. The core unit of account or the global reserve currency is the US dollar. I think there's a second alternative financial system. Basically think of this as the internet economy, right? That is a digital decentralized financial system. The core unit of account there is Bitcoin. If you look at what is going to occur in the legacy world, every single currency in the world is going to get digitized. We will have a digital dollar. We will have a digital euro, a digital yuan, a digital yen, right? We will have private currencies. So you'll see things like Libra and other companies launching these private digital currencies. And then you have something like Bitcoin. And so when you get in a world where every single currency is digitized, now what you do is you get a competition at the monetary policy level. Because if you're in Lebanon or Venezuela or Zimbabwe or in other places in the world, when you get locked in capital controls and people say, hey, you can't get out of your local currency, you then go and you look for dollars. But the black market is dangerous, right? In terms of one, you can get ripped off, and two, it's actually violent. Two is if you end up getting dollars and you put in your bank account, the bank could seize that money or your government could seize that money. And three is you could go into things like gold, for example, but it's super hard, right? It's not portable, it's not divisible, it's hard to buy things with, all that kind of stuff. And so what ends up happening now is you say, well, what money can I get on the internet? I have an internet connection. This is 2020. Like, how do I get my wealth out of my local currency into something else? And so if every currency is digitized, I now can buy just with an internet connection. I can buy dollars, I can buy yuan, I can buy euros, I can buy all this stuff. So you get every single currency is now accessible to me, right? That's in a steady state when everything's digitized. As we move towards that world, if only the digital yuan or the digital yen is available, or digital RMB, euro, whatever, and the US dollar is not digitized, then actually people have better access to other foreign currencies than the US dollar. Would be a huge problem for the US. So I think we should run and get a digital dollar as soon as possible. But once everything's digitized, you then have a competition not at the technology layer. You have a competition at the monetary policy layer. And I believe that both individuals and governments are going to believe that every single currency is being manipulated in the world. The US dollar, all the way down the right, euro, RMB, everything. So when you believe that everything is being digitized, or is being manipulated, you say, well, which one's not being manipulated? Oh, there's this currency that has a monetary policy that's programmatic, transparent, and it is completely out of the control of anybody else. It's a fully decentralized system. I trust that system because I at least know what's going on and I know I'm not getting screwed. If you look at countries, if all of a sudden Russia and China said, hey, we want to start to transact in another currency, but what they see is, wait, Russia's manipulating their currency, China's manipulating their currency. We don't want to use the dollar because it's an expensive, tough system for us to use. Instead, what they're going to start to say at some point, we will see countries say, well, why don't we use this other currency that's decentralized, that's transparent, that's programmable, that nobody owns? We know nobody's manipulating that one. Let's settle our transaction in a currency where no one has manipulation powers. And so I think that it is an inevitability that Bitcoin will rise to become the global reserve currency. Individuals and governments will see that. It is complete game theory. The second that one country says we're going to put it in our reserves, in our national reserves, or says we're going to adopt it, there will be a global FOMO and every country will rush in because there's only 21 million Bitcoin. That scarcity will drive immense value. I think that everyone is actually drastically underestimating the potential of Bitcoin. It is a market expanding technology, meaning that most people compare it to, can it capture the gold market? Can it capture the global monetary supply market? Gold's $7-8 trillion. Global monetary supply is $80-90 trillion. I actually think Bitcoin can capture upwards of 120, 130, 150, maybe even $200 trillion of total addressable market. How do they do that? Most people are incentivized to get out of their local currency, like we talked about with inflation, get into stocks, real estate, art, gold, Bitcoin, whatever. So they get out of their currency into these store of value assets. If all of a sudden you have a currency, though, that is a store of value, right? It doesn't devalue over time. It actually increases in value over time because it is a artificially capped supply. You're going to steal market share back from those assets into the monetary supply. And so I think that you could see something like a doubling of the global monetary supply with Bitcoin capturing majority of the market over a long period of time. Again, could take 20, 30 years. I just think that's the inevitability that we're going to see. So we'll see what happens there. Let's see here. All right, I'm gonna hang out for 10 more minutes. So get me all your questions, and I will answer as many of them as I can. Before I forget, if you want to hear more of this, please go and sign up. I write a letter every single morning to 50,000, literally over 50,000 people read this every single day. Please, I just put it in the chat. Go sign up, and you'll get kind of my thoughts on all this stuff every single day. Remember to like the video. Please subscribe to the channel. All that stuff. COVID. Yeah. So look, I think that one of the things on COVID that's really important here is it's serious, right? We are seeing an explosion. Now, one of the things that I've continued to say from day one is there is a complete lack of math and science in this country. Like, there is absolute absurdity going on. I have heard of things like if people die but tested positive for COVID, they count as a COVID death. Right? I literally know somebody I know, a family member of theirs died from cancer, and they had tested positive for COVID. And when they looked at the paper, it said COVID death. And the whole family was like, what do you mean it's a COVID death? Like, they obviously died from cancer. Like, we know, like, they've been suffering from cancer this entire time. But the hospital has a financial incentive to mark it as a COVID death. So there is a complete kind of manipulation of numbers going on one side. On the other side, right? So that was kind of the anti-COVID numbers argument. The pro-COVID number argument is that there is a rise in many places. So New York City, for example, there's a rise in the number of deaths that are uncategorized. And so there's a lot of people saying, well, what else could that be? People aren't getting in car accidents, all this kind of stuff, right? So my point is not, are the numbers undercounting or overcounting? My point is that we don't know. And I'll take it to this. So I saw yesterday a report that said the CDC is now reporting record numbers of COVID cases, right? Everyone's freaking out. But then it said, actually, one of the things that is happening is that some of the states are counting, they're double counting. If you test positive through the traditional test, and then you get an antibody test and you test positive, that counts as 2 COVID cases. So they're double counting people. In other situations, they're counting the antibody test as a positive case. But just because you have the antibodies doesn't mean that you actually have a hospitalization or you're showing symptoms or anything like that. And so, again, there's a lack of math and science. There's a lack of intellectual rigor, right? I have yet to see mainstream media question the numbers. Complete lack of intellectual rigor going on and looking at this. We're just taking the numbers that we're being given and we're saying, sure, they're okay. You can't do that because we can't make good decisions with bad data. So I think that we have to get a kind of reckoning there. Again, I don't know what the numbers are, right? I don't know if we're overcounting or undercounting. What I do know is wear your damn mask. It's not that hard. I love what the Georgia governor is doing. The Georgia governor said, right, this is like the epitome of threading the needle in terms of COVID. The Atlanta mayor got COVID and started to mandate, like, she personally got COVID. She began to legally mandate, you had to wear a mask. And the governor sued her. So the mayor is a Democrat, the governor is Republican. The governor sued the mayor of Atlanta and said, you cannot force people to wear a mask. You cannot legally mandate it, right? You are violating their constitutional rights. So he sued the mayor to stop it. But then he went on television and urged people to wear masks. So what I took away from that is he's not anti-mask. He's pro-mask, pro-constitution. He's saying we can't legally require people to do this, but we can strongly urge people, we can educate them, we can get them understanding what the impact of that is, et cetera. Again, is that the right answer? I don't know. But I do think that that's a very nuanced way to look at this, where you can be pro-Constitution and pro-masks, pro-science. Again, are there better solutions? Sure. There's all kinds of things that we can be doing. But I think that we've gotten into a world where there's the mob comes after people, right? The mainstream media. Like many people may have seen Bari Weiss. She quit the New York Times. Andrew Sullivan just quit New York Mag and Vox Media. And what they're basically saying is like, look, I can no longer say the things that I believe because the mob comes after me. And I was reading Andrew Sullivan. For those of you that haven't read it, I highly suggest going and reading his piece. He basically said, see you Friday, I think, or something. If you just type in Andrew Sullivan, see you Friday, you'll find his piece. And he said, look, in my newsroom, everyone hates me and they feel uncomfortable around me because of my conservative views. And he put it in air, like, I'm putting in air quotes. But he said, my conservative views are, I didn't want Trump as president. I came out as openly gay. I fought for, all of these social things. He's basically saying, look, like, I'm a Democrat. But he's like, but it's gotten to the point where I'm considered a threat because I violate the narrative, because I'm willing to talk about things that I don't even necessarily agree. I'm willing to have kind of intellectual rigor and independent thought. And so I think that is one of the things that we've got to get back to in this country, is we've got to start to seek truth over consensus. Who cares what the consensus is? Just because it's the consensus does not mean it's right. We have to find truth. That COVID cases, true. We got to find the truth. What is the number? How many people are dying? We got to have good data to make good decisions. In the economic world, we have to find truth. What is the economic reality on the ground? Who cares what the consensus is? What is the truth? In the social issues, what is the truth? Who cares what the consensus is? The truth has to reign supreme in our society, because the day you give up truth and you start to kind of optimize for consensus is the day that we lose our way. And so that is true across all, walks of life, and even in your personal life. And so I think that's the biggest thing right now that I'm paying attention to, is where are the independent thinkers? And again, the independent thinkers isn't this like weird world of, independent thinkers don't believe in coronavirus or masks. Actually, most of the independent thinkers believe in masks, right? If you look at most people in Silicon Valley who are kind of think from first principles and have independent thought and are, kind of constantly contrarian, they were some of the first people saying, hey, COVID's real. This is serious. We should go into lockdown, and kind of got made fun of for it. So I think that, again, we have to just get into this world where we seek truth over consensus. I think the economic situation that we're facing today is much, much worse than people are realizing. We're kind of, there's this mirage of the stock prices are going up. Everyone's making money in the top 50% of Americans, while the bottom 50% of Americans are getting absolutely ravaged. And I think that there's going to be a reckoning in terms of either we're going to have tons more stimulus in order to continue to kind of bridge us to an economic recovery, or you're going to see the stimulus expire and you're going to have to see a market correction in order to kind of meet economic reality. But we must seek truth over consensus. It is absolutely essential. All right, that's it. Please like the video, hour and 15 minutes or so. Like the video. Please subscribe to the channel. Go tweet the link. Let's get as many people watching this as possible. I'll start trying to do these more often if people are going to show up and watch them. If you guys share them and kind of gets the views that tell me it's worth the time, I will absolutely come and do more often of these. If you want, like I said, let me put this in here one more time. Every day I write a letter. It is my personal opinion on all sorts of different ideas in terms of business, technology, economics, Bitcoin, whatever. Click on that link, sign up for the email, and I will talk to you guys later. I hope every single one of you has a great weekend. Please stay safe, continue to be kind to your friends, and we will talk soon.